Welcome to the deep dive. Today, we're digging into the kind of public filings that can make institutional investors, well, pretty nervous, but market analysts very excited.
hmm
There's been a massive shift in the portfolio of Main Global Capital Management LP, and it's all about a name you've definitely heard of, SHAK, ticker SHAK.
Yeah, this is a textbook case of having to read the financial tea leaves. Main Global, which is a pretty big fund, has completely liquidated what was, until recently, a core holding in Shake Shack.
Right.
So our mission today is pretty straightforward. We need to unpack the mechanics of this exit, the what and the how from the 13F filing, and then, critically analyze the why.
The why, exactly. And we'll do that by comparing Main Global's immediate tactical move against the long-term underlying health of the Shake Shack business.
And that tension is really everything, isn't it?
It is. Is this just a savvy hedge fund trimming a volatile asset for a quick profit? Or is it something more, like a catastrophic loss of confidence in Shake Shack's whole strategy?
We're pulling directly from the SEC filings, and we also have some really detailed analytical reports to give you, the listener, a full picture of this intriguing separation.
Okay, let's not waste any time. We're starting with the brass tacks, the actual transaction.
All right, so the specifics of the exit are pretty clear-cut. We're looking at the 13F filing that they submitted to the SEC on November 14th, 2025.
Okay.
And that filing clearly states that Main Global fully exited its position in Shake Shack sometime during the third quarter of this year.
And it's the size of this move that makes it such a loud signal to the market, right? I mean, they weren't just pruning a branch. It feels like they ripped the tree out by the roots.
Precisely. We're talking about reducing their holding by 570,507 shares.
Wow.
The net position change was a huge liquidation. It totaled $80.21 million during that quarter.
80 million.
And most critically, the fund now reports absolutely no current position remaining in Shake Shack within its AUM. Zero.
That's what's so astounding. The context before this complete exit, Shake Shack wasn't some, peripheral holding they kept around for fun.
No, not at all.
It was Main Global's 8th largest position. It accounted for 3.4% of its total AUM. To just dump 3.4% of your fund in one quarter, I mean, that is a deliberate, definitive statement.
It is. It suggests a really strong change in their risk appetite or, their view on opportunity cost.
So the question everyone's asking is, was this a profitable exit or a painful cut?
That's the $80 million question. Analysts generally agree that given how volatile the stock has been, Main Global probably realized some profit.
Okay, so they took advantage of a price bump to get out.
It seems likely, yeah. Liquidate before a downturn they saw coming. But regardless of the P&L on the trade, the deeper implication is the redeployment of that capital.
Right. So where did that $80+ million go? You said there was a shift in focus. What does the Main Global portfolio look like now?
Well, if we look at their updated snapshot, it's clear they pivoted. They prioritized stability and some very specific massive growth engines.
Like what?
A lot of that capital flowed toward Microsoft, which is now their top holding at 6.8% of AUM. Also Broadcom at 6.3%.
So big tech.
Big, stable tech. But it wasn't just that. They also ramped up exposure to names like Eploven, Carvana, and Celsius, which is that high-growth consumer beverage company.
That's a fascinating mix. They went from a premium fast casual restaurant to a heavy mix of tech giants and these super aggressive specific growth bets.
Yes.
Does that suggest they see better value or maybe just less short-term risk completely outside of the restaurant space?
I think it suggests two things. First, a desire for massive, reliable scale, that's your Microsoft and Broadcom. And second, a rotation to high-growth areas where the runway might feel longer, away from the intense capital spending required by a physical restaurant chain.
These just sound better places to put that money.
It seems that they believe so, yeah?
Okay, so Main Global pulled the plug. Now let's look at Shake Shack's performance that led up to this. What was the market punishing so severely?
The numbers they're tough. As of late November 2025, the stock was priced around $87. But looking back over the last 12 months, it declined a punishing 33%.
33% is bad enough, but you always have to compare it against the market, right?
And that comparison is just brutal. During that same period, Shake Shack underperformed the S&P 500 by a staggering 46 percentage points.
46?
Yeah. I mean, that's not just underperformance. That's the market actively rejecting the stock. It signals a profound lack of confidence, which is exactly the environment that makes a fund like Main Global reassess things.
That kind of volatility must have been a portfolio manager's nightmare. We know the stock bounced between, what, $75 and $140 over the last year? That is a wild ride.
It's extreme. And it feeds directly into the analyst's speculation about Maine Global's motivation. One theory is that the risk just became, unpalatable. They had to make a tactical cut. The stock slid nearly 40% from its highs just since August.
But if they're a long-term institutional investor and 3.4% of AUM suggests this was a strategic holding, not just a trade, why liquidate everything based on a short-term slide? Why not average down if you believe in the story?
That is the critical question, and it's a challenge to that tactical cut theory. The complete liquidation suggests that either Maine Global sees some fundamental cracks that we can't see in the revenue numbers,
Sure.
or they just decided that the risk of holding this high capex volatile stock didn't justify the opportunity cost. Not when they could move that capital into safer, but still high growth, names like Broadcom.
So maybe the headache just wasn't worth the reward anymore.
It could be that simple. And we shouldn't forget, Maine Global has a history with SHAK.
Oh, right. They reopened their position in 2023.
Exactly. So the analysts are really focused on this pattern. Maine Global might just see Shake Shack as a great trading vehicle that also happens to be a great company.
So if the price gets low enough, the door is open for them to buy back in. This might be more of a tactical pause than a, declaration of doom.
It's a real possibility.
All right, we've spent enough time on the negative side, the stock price, the exit. Let's pivot to the business engine itself. Shake Shack is a premium brand. How does that translate into their financial structure?
Well, Shake Shack is a fast casual powerhouse. The revenue comes for those core premium things. The hamburgers, chicken sandwiches, fries, shakes. They target those urban high-density areas.
Right. Consumers and tourists willing to pay a bit more for that higher-end experience.
Exactly. You could almost call them the Lululemon of the burger world. It's all about quality and that brand loyalty.
And that brand equity is crucial. But financially, they're more complex than your typical fast food place, aren't they? It's not just corporate-owned stores.
That's right. They operate a key structure we call the hybrid business model. So they run and directly manage their own company-owned locations. But, and this is crucial, they also license their brand to partners, both here and internationally.
And that structure lets them expand really fast, especially overseas, without having to carry the full capital weight of every single new store.
Correct. It lets them leverage partner capital for speed and for global reach. But their main engine for domestic expansion is still the company-owned stores.
And those are incredibly capital-intensive to launch.
Incredibly. Which offers greater long-term profit, but it's the financial root of that valuation drag we're going to talk about.
Okay, let's put some hard numbers on the company's scale right now as of late November.
Sure. Shake Shack has a market cap of $3.5 billion. Over the last 12 months, total revenue is at $1.37 billion, which is solid. Net income for that same period is $42.6 million.
And to put that $3.5 billion market cap in context, they're not a McDonald's, but they are a significant player in that high-growth segment.
For sure. And these metrics, they really reflect a company that's prioritizing rapid growth and expansion over, immediate bottom-line profit.
So it's clear their whole structure is built for the long game, even if it looks a little messy on the balance sheet today.
Exactly. The investment thesis here is that you're buying future cash flow from a much, much larger store base, not trying to maximize this quarter's earnings.
So if the business fundamentals are that strong and the brand has this cult-like following, how do we reconcile that with a major fund just bolting for the exit? This is the core tension.
It is.
What are the undeniable positives that the analysts see?
Well, the first is the brand's ability to expand into new markets without losing its appeal. The demand is portable. But the real proof of their operational excellence, it lies in a metric that has nothing to do with opening new stores.
And that would be the same-store sales growth streak, which is, it's truly remarkable.
It is the most compelling internal metric we have. Shake Shack has grown its same-store sales for 19 consecutive quarters. Just think about that. Almost 5 straight years of existing locations bringing in more revenue than they did the year before. That shows successful execution, pricing power, and sustained customer loyalty. It's totally separate from the noise of opening new locations.
Is that kind of streak unique in the space right now?
It's rare. It's particularly impressive given how aggressively they're expanding. Maintaining that consistency for 19 quarters while you're undergoing massive organizational change, is highly, highly difficult.
It really implies a fundamentally healthy operational model.
It does. And speaking of expansion, they're leveraging that health into what sounds like an incredibly aggressive growth plan.
It is aggressive. They grew their store count by 14% last quarter alone, which brought them to 630 locations. But the long-term goal is the real eye-opener.
Yeah, management believes it can quadruple the number of its company-owned stores.
Quadruple. So from 630 to what? Over 2,500 company-owned locations. That kind of growth requires staggering amounts of capital expenditure or CapEx.
Immense capital. And that massive spending leads us right back to the main global problem. That aggressive growth spending directly impacts the company's current valuation. It creates what analysts call the valuation drag.
Okay, so explain that drag for the listener. The stock is trading at just 18 times cash from operations. That sounds pretty low for a growth stock. Why is that multiple so depressed?
It's low because of the CapEx. When Shake Shack spends huge sums to build new stores, those dollars get recorded as capital expenditures, which significantly reduces their calculated cash flow in the short term.
So the profits they generate are just immediately recycled back into growth.
That's it. It makes the company look less profitable on paper today.
So the current valuation is basically punishing them for their massive long-term ambition.
Exactly. It's this perfect collision of financial reporting and long-term strategy. The analyst commentary gave us a fantastic counterfactual to prove this. They estimated that if Shake Shack were to suddenly just abandon its plan to quadruple its store base, if they stopped all that heavy CapEx, the valuation would instantly shift. It would trade between 22 and 25 times free cash flow.
That is a profound insight. It tells you the core business is highly profitable, but the current financial metrics are being artificially held down by a deliberate investment in the future.
It validates the business model. And when you factor in their historical growth sales up 17% annually over the last 5 years, 15% this year, it positions Shake Shack as a very promising growth stock if you believe management can execute that plan.
So Main Global may have sold, but analysts focused on fundamentals see a company priced for tomorrow, not for today's depressed earnings.
That's the story.
Okay, so this deep dive gives us such a clear picture of the difference between institutional risk management and fundamental business value. We've synthesized the data showing that a highly sophisticated fund, Main Global, looked at the volatility and the immediate numbers and just decided to fully exit.
Right. Main Global's decision tells us about portfolio strategy. They decided the risk of SHAK combined with that temporary valuation drag was a worse bet than shifting capital to tech or somewhere else. It's a risk management move.
But then you have the underlying operational data, the 19 consecutive quarters of same-store sales growth, the successful brand expansion, and that tells a story of a business that is successfully executing a decade-long plan.
This is the perfect collision. You have short-term portfolio mechanics running headlong into a long-term capital plan. And for you, the listener, the key takeaway is that you can't read a filing like a 13F in a vacuum.
You have to connect that financial move to the core business metrics to really understand the tension.
You do. And that resilience brings us to the ultimate choice facing anyone tracking this company. Shake Shack has stated its goal is to quadruple its company-owned stores, and we know that's creating the valuation drag, keeping the multiple low at 18x.
So that raises an important question for you as you evaluate these kinds of investments.
Right. Which factor matters more in your analysis? Is it the current earnings, which are suppressed by all that spending today? Or is it the potential size and financial value of this business a decade from now, assuming they actually hit that ambitious goal?
That's the question that defines whether you're a short-term trader or a long-term investor in a high-growth model. Thank you for taking this deep dive with us.